Hi, my name is Todd Artwell, Fixed Income Senior Strategy Manager here at Howe and Rusling. Today I will be discussing the yield curve and what it tells us. A yield curve is a line that plots the interest rates at a set point in time of bonds having equal credit quality but differing maturity dates. So it is bond yields of various maturities. The most frequently reported yield curve compares the 3-month, 2-year, 5-year, 10-year, and 30-year U.S. Treasury debt. The yield curve is used as a benchmark for other debt in a market, such as mortgage rates or bank lending rates. The shape of the yield curve also gives an idea of future interest rate changes and economic activity. There are 3 main types of yield curve shapes: normal, inverted, and flat. A normal yield curve is one in which longer maturity bonds have a higher yield compared with shorter term bonds. In a normal yield curve, the slope will move upward to represent the higher yields often associated with longer term investments. These higher yields are compensated for increased risks normally involved in longer term investments. The shape of the curve is referred to as normal or positive in that it represents the expected shift in yields as maturity dates extend out in time. A normal yield curve indicates yields on longer term bonds may continue to rise, responding to periods of economic expansion, which in turn generally increase inflation expectations. On rare occasions, the yields on shorter term bonds are higher than the yields on longer term bonds. When this happens, the curve becomes inverted, which can be a sign of an upcoming recession. An inverted yield curve indicates that investors will tolerate low rates now if they believe rates are going to fall even lower later. Investors are expecting lower inflation in the future. In a flat yield curve, the shorter and longer term yields are very close to each other, which is also a predictor of an economic transition. When the economy is transitioning from expansion to slower growth or recession, yields on longer maturity bonds tend to fall faster than shorter term, taking a normal yield curve into a flat yield curve. Here, a flattening yield curve signals that inflation and interest rates are expected to stay low and that markets expect little economic growth. When the economy is transitioning from recession to recovery, yields on longer maturity bonds rise faster than shorter maturity securities, tilting an inverted yield curve towards a flat yield curve. This steepening curve is typically due to the market now anticipating stronger economic activity and rising inflation expectations. Here are the key takeaways. The shape of the yield curve changes in accordance with the state of the economy. The normal or upward sloping yield curve will persist when the economy is growing. Conversely, the inverted or downward sloping yield curve is likely an indication that the economy is headed for a recession. Investors pay close attention to the yield curve as it provides an indication of where interest rates and economic growth are headed in the future. I hope this helps your understanding on how we use the yield curve as a tool. Thank you for tuning in to StreetSmarts, presented by Howe and Rusling.